All right, so we're going to look at some more practice problems for chapter 5. And this time I'm going to use the calculator on my website so that you can get a good idea of how to use the cash flow mode for the calculator on my website, which is slightly different from the BA2 Plus that I used in the other practice problem video. All right, so the first question is, you are a real estate developer in Auburn, and you're deciding whether or not to renovate an old unoccupied apartment building that you have inherited or you already own, right? The building is ideally positioned near campus so students can use it, and you can accommodate 10 apartments that each generate $20,000 per year on a net basis. So think net cash inflows. The renovation would cost $1 million that you would need to pay right now. Now, the renovation would take 1 year to complete, so you can't expect any cash inflows during that first year. But once they get started, you can expect revenues for 15 years. So technically, that would be starting in the second year, and the appropriate discount rate to use in this case is 20%. So the question is, what is the net present value of this opportunity? Ultimately, you want to decide, is this worth it? Okay, so let's talk about the cash flow situation and what the timeline looks like. So you can see assuming we would have, full capacity, in other words, all 10 apartments rented, we can expect to generate $20,000 times 10 in dollars per year. So that would be $200,000 per year. So once we are able to rent the apartments, then we can expect to receive $200,000 per year for 15 years. But the important thing to recognize here is that there's going to be 1 year for renovations, and so the first year you're not going to see any cash flows. So that's what the timeline looks like. I tried to make this example more real life, real life is more complex. So this problem is a little bit more complex than we've seen before. It's not that complicated, but and you wouldn't see anything, like this that might trip you up unnecessarily on the exam. But just to show you what it looks like. All right, so let's talk about how to calculate the NPV. So we go over to the calculator, and what we want to do first is clear everything out, right? Make sure you reset it because you don't want to carry things over from the last problem that you worked on. All right, and so now we want to input the cash flow. So I'll press CF, which stands for cash flow, and it puts the calculator in cash flow mode. Now it's asking for the cash flow at time 0. Time 0 is right now, which is in the problem when I would spend $1 million on renovations. So I'm going to put $1 million, and I'm going to make it negative because for me that's a cash outflow. So I'll put a negative 1 million and press enter. I'll go down, and now it asks me for the first cash flow. Now remember, the first year is taken up with the renovation, and so I will not have the apartments rented, and therefore there will be no cash inflow. So I'm going to leave that blank, and I'm going to go down, and the frequency is 1 because it only takes 1 year to renovate. And then once it's renovated, I can rent it out for 15 years, and that's going to be $200,000 per year that I receive on a net basis. So I'm going to key in 200,000, and I'm going to make that positive because the rents, right, are going from the renters to me. And so the 200,000 is going to be positive. So I'll press enter. I'll press down, and you can see it says FO2, which stands for frequency of this second cash flow. Now the frequency is actually 15 because I am expecting to receive $200,000 for 15 years. So that is going to be 15. So I'll key in 15 for the frequency of this $200,000 cash flow. All right, so now you can see, if I just browse the timeline, you can see that, it says 1, but it actually means cash flows at time 0. But it just means the first cash flow. But you can see I have the timeline. This is what the timeline of cash flows looks like. Remember, that first year is spent renovating this property. So we're not actually receiving any cash inflow. It's just flat. All right, so now before I calculate the NPV, in order to calculate the NPV, I have to have a discount rate. So I need to input the discount rate. And this is where a big difference between this calculator on my website and the BA2 Plus. So what I'll do is, you can see the discount rate is 20%. So I'm going to key in 20 and then press I over Y. Whoops, that's not right. 20 and then I over Y. So you can see it says, okay, the interest rate is set to 20%. So I pressed 20 I over Y. Now I can press compute NPV. And it's telling me the net present value is negative $220,755. Okay, so the question is it worth it? And the answer in this case is no. No, because the net present value is negative 220,000. Why is this the case? Well, it boils down to the discount rate that I use and the size of the cash flows. So if I computed 200,000 times 15 years, then yeah, that's going to be more than $1 million. But first of all, I have a year gap here, and I need to generate at least a 20% return on this investment. And after accounting for that, the net present value is 0, meaning that I'm not going to reach that 20% level. Next question is, at what discount rate is the NPV exactly equal to 0? Now, notice that I've used an interest rate of 20%. And that's because from the part 1 of the question, as I was looking into this potential opportunity, I may have looked at opportunity costs or considered the risk of the project, and that is what brought me to the discount rate of 20%. But I can, if I lower that interest rate, then what that will do is bring up the NPV. So the question is, at what discount rate is the NPV exactly equal to 0? Well, it's going to be less than 20. As I push the interest rate down, there will be less discounting that is occurring in the timeline of the cash flows, which means the present value of these future cash flows is going to be higher. And that's going to cause the NPV to be higher and to approach 0, given that it's in the negative territory. Okay, now this question is tricky because what this is referring to is the internal rate of return. Remember, the definition of the internal rate of return, the IRR, is the point at which the NPV is equal to 0. So what is the rate that I have to key in to make the discount rate, or to make the NPV exactly equal to 0? That is the IRR. So to compute that, I can do, on the calculator, I can press compute IRR, and it says 15.295. So, just over 15%. So it's not that this, opportunity has a negative return. It's just that the return is less than my required return. And because it's less than my required return, my NPV is going to be negative. But if I had used a discount rate of 15.295, then my NPV would have been exactly equal to 0. And that is the internal rate of return by definition. Okay, I hope that makes sense. So you can see the NPV is flexible. It depends on the inputs, right? So it depends on the discount rate that I use. And again, when the net present value is less than 0, it suggests that it's a value destroying activity. I still receive a positive rate of return because you can see the internal rate of return of this project is 15.29, which doesn't sound that bad. But remember, my discount rate, the required return that I need, is 20% in order to make this project worth it, right? It could be the case that I have other projects that I'm considering, right? I don't have to use this $1 million on this particular project. Maybe I have other projects that I'm looking at, and given the rate of return on those other projects, I'd have to have at least 20% rate of return on this one. So, it's just all it's all relative, right? All right. But it's important to step back and think about the relationship between the discount rate that I use and the resulting net present value. And the definition of the IRR is the point at which the NPV is exactly equal to 0. All right. Next part of the question is, what is the payback period? Well, you can see the cost is $1 million, so that's what we're paying back. And the revenue generated, or the net cash inflow, is going to be $200,000 every year. But remember, the first year we don't generate any cash flows. So $1 million divided by 200,000 is 5. Plus the additional year is going to make our payback period 6 years. And then another question is, what is the profitability index of this project? So the profitability index is going to be equal to the present value of the cash inflows divided by the initial cost, which in this case is $1 million. Remember, the net present value is the present value of the cash inflows minus the initial cost. The profitability index is the present value of cash flows divided by the cost. So it's very similar, but at the same time, it's different, right? Like I mentioned in the lecture, the profitability index, essentially by dividing, is essentially scaling by size. So a small project may have a great profitability index, but an NPV that is relatively small, just because it's a small project. All right, so to find the profitability index, we've already calculated the NPV, so that's what we're going to look at. So the NPV is negative 220,755 or so. Now, what that tells me is that, I know the initial cost is $1 million. And because I know the NPV, I can easily back out what the present value of the cash inflows is. And that's going to be $1 million minus 220,755. So I'll go ahead and write that down. So the initial cost, so I'm going to say the profitability index is equal to the initial cost plus the net present value. In this case, the net present value is negative, and so the present value of the benefits is going to be a little bit less than $1 million. So it's going to be minus 220,755. And so I can just, do the math on the calculator. And so $1 million minus, why does it have IRR? I'm going to exit cash flow mode. So I'm going to have $1 million minus 220,755. So that gives me 779,245. So the profitability index is going to be this amount divided by the initial cost. So I should have included that at the beginning, which I didn't do. So that is going to be 0.779. Okay, and so with the profitability index, whether or not we pursue the project depends on whether the profitability index is greater or less than 1. I prefer it to be greater than 1. And so because it's less than 1, I'm not going to pursue this project. Or according to the profitability index, I should not pursue this project. That's kind of what's going through my head. All right, so that's it for question 1. We're just going to look at one more question, and then we'll be done. All right, question 2. Let's say you're starting an internet company, and you've just obtained $100,000 in seed financing. And you expect that this $100,000 is sufficient to cover the cost to hire programmers, accountants, and lawyers, and other things that you need in order to get the business going. You don't expect any cash flows for 2 years. It's going to take you 2 years to kind of start generating cash flows. But once you do, you expect to generate $25,000 and then $50,000 and then $75,000 over the next 3 years. So again, you're looking at a 5-year timeline here, where the first 2 years do not generate any cash flows, but then the next 3 years do. And the question is, given these expected cash flows, what is my rate of return on a project like this? So that is something we can compute. That's called the internal rate of return. And so let's go ahead and switch to cash flow mode on the calculator and input our timeline. So the first thing that's going to happen is I'm going to use this $100,000 that I've raised to cover the cost of getting this internet company up and going. And so that's going to be a negative number because that's what I'm paying for. So that will be inputted as the cash flow at time 0. And the first cash flow is going to be 0. Remember, because for 2 years, I'm going to be kind of like in hibernation, right? I'm going to be just trying to get things up and running. And so, which is not uncommon, right, for young startup companies like this. And so 0 is going to be my cash flow, and it's going to occur for 2 years. So you can say as soon as I do that, as soon as I input frequency is 2, you can see it has 2 years of 0 cash flows. And then I go down, and the first cash flow that I generate technically in year 3, right, is $25,000. So I'll key in 25,000. That occurs once, and then I bring in 50,000. That also occurs once, and then I bring in 75,000. That occurs once, and that's the last cash flow. So now my timeline is completely entered. I'm ready to move on to the next thing. Now, notice that I haven't been given an interest rate, and technically I don't need one to calculate the internal rate of return. So I can go ahead and compute the IRR, and that is 9.87%. So my rate of return on this project is almost 10%. Okay. So that's the answer to the first part. So given the substantial risk, the required return is at least 25%. Should you proceed? Now think about this. The cash flows that I just looked at, that I inputted into the calculator, and I said, what is the internal rate of return? It gave me 10%, or just under 10%. My required return is 25%. That's a pretty substantial difference. The answer is no, I'm not going to proceed because 10% is way less than the 25% that I require. The next question is, does this mean the NPV is positive or negative? It means the NPV is negative, right? Because if the internal rate of return is less than the discount rate or the required return, in this case 25%, if it's less, then automatically the NPV is going to be negative, right? That's something that you should have memorized, right? It's on the relation between the NPV and the IRR. So because 10% is less than 25%, I'm not going to proceed with this project, and the NPV is negative. Okay. And then the last question is, how long does it take until investors get back their initial investment? So you can see, this brings in, again, the payback period brings in this practicality element that is somewhat missing from the NPV and the IRR. And so you can see 100,000 is the initial investment. So the question is, how long until investors get back their full 100,000 that they put in initially? Now, over the first 2 years, no cash flows are going to be generated. So, automatically we're going to have 2 years before we see anything. And then it goes from 25 to 50. So after 4 years, we've only collected 75,000. And then in the very last year, in year 5, we bring in 75. So we have 25 plus 50 is 75. So we have 25 left, right? 100 minus 25 minus 50. And then 25 divided by 75 is 1/3. So the answer is going to be 4 1/3. So 4.3333 years is going to be our payback period. That's kind of long, right? So not only does this potential project have a relatively low rate of return, right? 10% when our required return is 25%. The payback period is pretty long, right? It takes over 4 years, 4 years and a third year, 4 1/3 years to get fully repaid. All right, I hope that was helpful to see how the calculator on my website is used for the cash flow mode. If you have any questions, please just send me an email. I'm happy to help.